Hey Facebook, Derrick Harper here, CEO Point Boosters Credit Repair. Wanted to reach you guys today to kind of touch bases on how credit works. Don't want to waste you guys' time. Kind of want to cut down on 45 minutes of having to do a consultation on the same information over and over. Don't get it wrong, I don't mind giving those consultations over and over, but it's a lot easier here to kind of cover the information of how credit works and your whole credit repair, your whole credit profile. So, kind of join me. I wanted to kind of do a quick breakdown of the point system and how your credit report works. The lowest score that you could get on a credit file is a 300. The highest you can get is a 850. So that leaves about 550 points to play with from the lowest to the highest. I know a lot of people want an 800, want an 820, want an 840, but the reality is, mark my words when I say this, there's nothing that you can get with an 850 that you can't get with a 750. But in order to obtain an 850, it's kind of, there's no reason behind it because you're obtaining an 850 for the purpose of obtaining a loan. The moment that you apply for that loan, you're going to drop points immediately. So I kind of wanted to touch bases on that. So a lot of people, they say things like, hey, just pay your bills on time, just pay your bills on time, and you'll have a perfect credit score. I mean, of course I encourage you to pay your bills on time, and that's kind of the purpose for this video. But did you know that paying your bills on time only accounts for 35 points of your credit score? 35%, I'm sorry. So let's do the math on this. The lowest you can get is a 300. The highest you can get is a 850. So 35% of your credit score on a 550 point scale, as far as the most you can get, that's 192 points. So let's say if you did every other thing wrong and you pay your bills on time. That puts you from a 300 to a 492. It's kind of crazy, because you're doing everything else wrong and you're losing the other points. So that's what I came to talk to you guys about today, the other 65% of your credit score. So let's do a quick breakdown. The 35, like I said, is a payment history. That's 35% of your credit score. And, that's, hey, you've been paying all your bills on time, you never missed a payment. That's fine. But then you also know that you can make every minimum payment on your credit card, max all your credit cards out, and pay all your bills on time, have 100 inquiries on your credit file, have one credit card, and no other types of credit, and you still might not have a 600 credit score. So that kind of, I'm not saying don't pay your bills on time. Of course you want to pay your bills on time. But let's get into the other 65%. So let's break it down with the 30% of your, the other 30% of your score, which is the length of credit history. So keep in mind when you have student loans, or when you have a car note, or when you have a mortgage. So, me, for instance, a couple months ago, I paid a mortgage off. And when I paid the mortgage off, it dropped my score a little bit. And I remember back a couple years ago when I paid my other mortgage off, I had that account like 9 years. And that was one of the oldest accounts that I had, because I had student loans that were about 8, 9 years old. So when you think about the length of your credit history, that's one of the biggest things on your credit file, because that carries 15% of your score. So let's say I have 10 accounts. Let's break down in easy numbers. So if I had 10 accounts right now, and 9 of those accounts have been open 10 years, the age of my credit history will be approximately 10 years old. I open an account tomorrow, my credit age actually goes to 9 years old. So your score will actually drop based on re-aging your credit history, or the length of credit that you have, because now the average age of my credit is 9 years instead of 10 years. So you always want to keep in mind that paying that car off, that paying that loan off, not necessarily means that your credit score is going to go up. So you have to keep in mind also that, to kind of slow it down, I get a lot of calls and a lot of clients that they're on the path to do the right things, they want to do the correct thing, but they automatically think that because they paid 2 cars off that they had open 5 years apiece, that their credit score is supposed to go up. But guess what? Let's say if they only had 2 more accounts that just got open that was only 3 months old. So now you re-age your whole credit history from 5 years old to 3 months old. So now you're more of a risk to the new people or to the banks, because they're going to look and say, hey, we can only really evaluate you on your open accounts that you have. So now that you only have those accounts open for a short amount of time, that's what they're going to go by. Now, the good thing is, based on your credit history, positive accounts do stay on your credit for 10 years. But by law, there's no law that actually dictates the credit bureau, the creditors, to even report it to the credit bureau on positive accounts. There's only a law out there that dictates if they do report it, they have to report the right information on it. So I kind of want to get back to it. So the other 65% is we're using 30% debt ratio. So if you max out your credit cards, you lose that 30% from the beginning. I've seen people, come in, never missed a payment, never paid late on anything with 580 credit scores. I've also seen people that come in with 8 missed payments but have perfect debt to ratio. They're using less than 5% on their credit cards and they have very high credit scores. Because one thing that you can rebound from is a 30-day late payment. It takes about 9 months to rebound those points back from a 30-day late payment. So when selecting to work on your credit or to have anybody work on your credit, you don't want to have that person just delete, or dispute because it's negative. I've seen an account get removed that actually cost the client 90 points because it showed up negative, and all it was a 30-day late. They rebounded from that in 9 months. So now you have to actually evaluate a credit report, because a lot of people come in and they say, oh, well, I can just send disputes, and they can't tell me what the FCRA is. FCRA, Fair Credit Reporting Act. It's a law out there that actually protects you from the way that your things are getting reported, and it lets you dispute something that's in question. Mm-hmm. So 30% debt ratio, 15% length of credit history, 10% is types of credit, and 10% is the number of credit inquiries. So debt ratio, like I covered, that covers, it's mostly pertaining to your revolving credit line. So, if you have a $3,000 or $1,000 credit card, we'll keep it pretty simple. So a $1,000 credit card, you always want to keep the balance below $300. I don't want to really teach you guys into playing the statement game, because, you might fall behind, you might not, so I'm not even going to kind of touch into that. But whatever you use on that credit card, you're kind of you're getting your kind of evaluation based on how responsible you are with that credit card. So you want to make sure that you're really responsible and not going over 30%, because it raises a red flag to a lender. It's going to tell them that, hey, if you guys can't pay your credit card bills on time, you probably don't have that money in the bank. So in the case, they rate you in the case of if something happens. Will you be able to come up with that payment to pay them? So you kind of want to remember that. And a lot of people, I got a question in my inbox now of why credit cards matter so much. And that's one of the things I cover with all of my clients. So credit cards, it can be used as a tool. I don't want you guys to think credit is a trap. Credit is actually a tool to actually benefit you in life. Because the average person that goes through life, our working age is from 18 to 62. So that's 44 years of work. So if you calculate that, in the 44 years of work, a person that lives with an average credit score of 550 through life pays $488,000 on average than a person who lives with an average credit score of 700 with the same exact standard of living. The same exact thing. So do you want to pay that $400 and something thousand to yourself, or do you want to pay that $400 and something thousand to build somebody else's dream? And that's the problem that a lot of people run into when it comes to credit, and that's why you want to use it as a tool. I also want to cover, the type of credit. So I call it the trifecta effect. You want to have a revolving line, you want to have an installment line, and you also want to have a mortgage line, real estate line, or something like that. Because now that lets them know that you have all kind of different types of credit, and you can actually manage and maintain that credit history. A lot of people actually think that, hey, I make so much money, I make $300,000-$400,000. I would prefer a person with an 800 credit score before I prefer a person with $100,000 in the bank. At the end of the day, that person with that 800 can get his hands on $100,000 and use it in credit and still have the money there that he had. That person with that 100 grand with bad credit has to use everything in cash that he has, and once that cash is gone, it's gone. You don't have a bailout. You don't have that second chance there. Credit is your second chance. I don't care who says credit is bad. I mean, we heard the old myth that you don't want to pay interest, you don't want to pay interest, you don't want to pay interest. But let's be honest. Do you want to spend your money on building your dream, or do you want to spend your hard work through credit and paying your bills on time to build your dream? So the last 10% that I want to kind of cover with you guys are the number of credit inquiries. So I know a lot of people join programs and they start working on their credit and their score actually starts to go up. But the purpose of building your score, it's a class that we teach that we don't teach you how to get a 720. We try to teach you how to live with the 720. And that's a big difference because, I mean, anybody can really obtain a 700 to a 720 credit score. But did you know that less than 5% maintain a 720 or better credit score that once had a 700 credit score or a 720 credit score? So that's one of the things you want to keep in mind. The first way to ruin that is to go applying for anything because you think you can get it, because your scores actually jump. And that's one of the biggest misconceptions out there. You start getting all kind of ads saying that you're pre-approved for this, pre-approved for that. Now, don't get me wrong. It's always good to have a few credit cards in your corner in case of an emergency, but you don't want to overdo it and you don't want to apply just because you know you get it. So based on the 300 to an 850, let me break down the score, the kind of scores to you. So let's start everybody with a 300. Now, of course, you don't start with a 300, but let's say if your payment history is perfect, you don't have anything missed, you get 35% of your score right there. The most you can gain or lose with paying everything on time is 192 points. So that takes you from a 300 to a 492. So now let's look at your debt ratio. That's 30%. So let's say if you keep that below 5 to 10%. I know everybody says 30. Anything over 30 makes you high risk. I prefer 5% or less. So you want to make, if you got about 5%, the most you can get with having a perfect debt ratio is 165 points. So, take that 492 and add 165 to it. Can't do my math. There's, let me see, 56, 58. So that puts you at about, 558. Or 658, I'm sorry. So you sit with a 658 with just a perfect payment history and a perfect debt to ratio. So you're sitting at a 658 credit score. Of course, everybody wants a 700. So help me out. So now you're looking at the length of credit history. So of course, most people that have 750s or more, they have about an average credit age of about 8 years. So yeah, of course you say, hey, I want to get credit card, I want to get credit card, I want to get credit card. But the more credit cards you open, I mean, you're cutting your credit age in half. But that's not too bad. Like I said, it's only 15% of your score. And by maxing out that 8 to 12 years, the most you can possibly get is 82.5 points on your credit score. So now, types of credit. Like I said, completing the trifecta will automatically maximize the 55 points you can get from, the different types of credit that you have. So if you have a mortgage on there, you have an installment loan, which is usually a car or personal loan, and you have a credit card that you're managing pretty well. So you can maximize and get about 55 points there. But just remember, anything over 8 inquiries or more, I really say 5, but you get around 8 inquiries or more, you losing 55 points. And it's kind of not fair that you have to actually have a mortgage, an installment loan, and a credit card or something like that to get the 55 points, and you can lose it just by, running your credit a few times. So, I mean, it's easier to lose points in your credit than it is to gain. So that's why it's important that you guys want to take care of. So I hope you guys found this information, helpful. And I just, that's the part of the other 65 that I wanted to cover. So now, for the next couple minutes, I just want to kind of get into your credit report. I want to dig in a little bit because there's a lot of misconceptions going out of, of the hard work that we put in, and the colleagues that I work with and other credit repair business owners that we share stories with. A lot of the clients, it's not the fact that they don't, that they're being rude or they expect something that, that we can't do. It's mainly the fact that, they don't know. There's a lot of information they don't know. did you also know that, I mean, you can actually get something reported on your credit file that completely isn't yours, or that let's just say if it is yours. Let's say if you go to the hospital today, they had to do something on you. Insurance paid about $300 on it. It was a $600 bill. You owe $300. So now that $300, of course, you owe that to the hospital. Whatever you owe the hospital, that's between you and them. You owe them. I mean, it's it's nothing wrong with that. So now it's a possibility that a collection could pop up on your credit file, and you contact that creditor and actually pay that debt. Did you know that by law you probably still can be legally liable for paying that $300 to whoever really owns that debt? Because you might not necessarily know if that person who bought that debt actually owns it. That's why you have to make sure that you validate anything before you pay it. Of course, there's a lot of info and a lot of things that these big banks pay the lobby groups to tell you, hey, nobody should tell you not to pay anything. Nobody should tell you not to pay anything. I'm personally telling you not to pay anything unless they validate. Now, validate everything looks right. Like I said, you owe them that $300. But you want to make sure that you're paying the right person and that you can't be sued by somebody else who you really owe on that. So keep that in mind, because you might not know that 80% of the mistakes that are on credit files are made, from things like that, paying the wrong creditor or reported by the wrong creditor. So if you look at the fact that of the wrong accounts that are reported, or the errors or things that they can't validate are on your credit file, or reported by the wrong creditor or a person who bought a spreadsheet and say you owe me now. So I hope, I help you guys in some way. I had like about 10 minutes and today's been really busy. So I decided to answer some questions because I couldn't answer everybody's questions, and I hope that helps somebody. So play the video back, share it, comment. I love info. I love to go back and forth. So I hope that helped out, and I hope that you guys get a better understanding of the other 65%. So it's not just about paying all your bills on time, just to summarize. It's about keeping the ratios right. It's about, lengthening that credit history, not being so quick to pay things off fast, thinking that they're going to be your friends because you paid it off 3 years early. You might want to keep it open a little longer. Types of credit, make sure that you complete the trifecta or more, and, keeping those credit inquiries down. This is Derrick, CEO of Point Boosters. You can actually add me on Facebook. I love sharing information. You can look at our website, pointboosters.com, credit info. It was great sharing information with you guys. Long night, I'm sorry. All right, you guys enjoy. Take care of yourself.